Look, I need you to pay very close attention to what I'm about to tell you because what's happening right now in the gold market isn't just another price move. This is different. This is the kind of moment that comes along maybe once in a generation, and most people are going to miss it completely because they're not paying attention to the right signals. Gold just hit $4,000 an ounce. Let that sink in for a second. $4,000. And here's what nobody's talking about. This isn't speculation driving this move. This isn't retail investors piling in. This is central banks around the world quietly, systematically, aggressively accumulating physical gold at a pace we haven't seen in modern history. In the third quarter alone, central banks bought 220 tons of gold. That's a 28% increase from the previous quarter. These are the smartest money managers on the planet, the people who have access to information you and I will never see, and they're loading up on gold like their lives depend on it. Why? What do they know that the average person doesn't? Let me paint you a picture of what's really happening behind the scenes. For decades, the global financial system has operated on a very simple premise: trust in the US dollar. The dollar has been the world's reserve currency since the end of World War II. Every major commodity, from oil to wheat to copper, gets priced in dollars. Countries hold dollars in their reserves. International trade happens in dollars. The entire system is built on this foundation, but that foundation is cracking, and central banks can see the cracks widening. Think about what's happened over the last few years. The United States has weaponized the dollar. When Russia invaded Ukraine, what did the West do? They froze Russia's dollar reserves, hundreds of billions of dollars, just locked up, inaccessible. Now, whether you agree with that decision or not, isn't the point. The point is that every other country in the world watched that happen and thought, if they can do that to Russia, they can do that to us. China watched. Saudi Arabia watched. India watched. Brazil watched. And they all came to the same conclusion. Holding dollars is a risk, a political risk, a sovereignty risk. If your reserves can be frozen with the stroke of a pen, are they really your reserves? So what's the alternative? Gold. Physical gold. Gold that sits in your vault, in your country, under your control. Gold that can't be frozen by a foreign government. Gold that can't be printed into oblivion. Gold that has been money for 5,000 years and will be money long after every fiat currency in existence today has turned to dust. The numbers tell the story. Central banks have been net buyers of gold for 16 consecutive years. 16 years. But the pace has accelerated dramatically. We're not talking about modest diversification level buying anymore. We're talking about aggressive accumulation. China's central bank has been buying gold every single month. The People's Bank of China doesn't do anything without a strategic reason. They're not buying gold because they think it's pretty. They're buying gold because they're preparing for a world where the dollar is no longer king. And it's not just China. Poland has been buying. Singapore has been buying. India has been buying. Turkey has been buying. Even countries that have historically been staunch U.S. allies are quietly diversifying away from dollars and into gold. The message is clear. The smart money is moving. Now, here's where this gets really interesting. While central banks are buying physical gold, there's a massive disconnect happening in the paper gold market. The COMEX, the major futures exchange where gold gets traded, operates on a fractional reserve system. For every ounce of physical gold in the COMEX vaults, there are multiple claims on that gold through futures contracts and derivatives. Some estimates put the ratio at 100 to 1 or even higher. That means there are 100 paper claims for every single ounce of actual physical gold. What happens when people start demanding delivery? What happens when the music stops and everyone realizes there aren't enough chairs? That's the squeeze that's building right now. That's the pressure that's pushing gold to these record levels. And we're just getting started. Let me tell you a story that perfectly illustrates what's happening. Back in 1971, President Nixon closed the gold window. Up until that point, foreign governments could exchange their dollars for gold at a fixed rate of $35 an ounce. But the United States had been printing so many dollars to fund the Vietnam War and domestic spending programs that foreign governments started getting nervous. France, under Charles de Gaulle, actually sent a warship to New York to pick up their gold. They didn't trust paper promises anymore. They wanted the real thing. Nixon had a choice. Either hand over America's gold reserves and watch them drain away, or break the promise and close the window. He chose to close the window. The dollar became a pure fiat currency, backed by nothing but faith and the full credit of the U.S. government. And what happened to gold? It went from $35 an ounce to $850 an ounce by 1980. a 24-fold increase in less than a decade. We're seeing echoes of that same dynamic playing out right now, but on a much larger scale. The difference is that in 1971, it was just a few countries getting nervous. Today, it's the entire world questioning the dollar's dominance. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working on alternatives to the dollar for international trade. They're setting up currency swap agreements. They're exploring the possibility of a BRICS currency backed by commodities, including gold. Saudi Arabia, the linchpin of the petrodollar system, is now accepting payment for oil in currencies other than dollars. This isn't conspiracy theory. This is happening right now, in real time, and it's being reported in mainstream financial publications. The world is de-dollarizing, and gold is the beneficiary. But here's what most people don't understand about gold. Gold isn't an investment in the traditional sense. Gold doesn't produce cash flow. It doesn't pay dividends. It doesn't grow earnings. Gold is insurance. Gold is the ultimate form of wealth preservation. When everything else is falling apart, when currencies are collapsing, when governments are defaulting, when banks are failing, gold holds its value. Gold is the asset you own not because you think it's going to make you rich, but because you want to make sure you don't become poor. And right now, the risks to the traditional financial system are higher than they've been in decades. Government debt levels are at all-time highs. The United States is running trillion-dollar deficits as far as the eye can see. The Federal Reserve's balance sheet is bloated with assets that nobody else wants to buy. Commercial real estate is in crisis. Regional banks are sitting on massive unrealized losses. The stock market is trading at valuations that only make sense if you assume everything is going to be perfect forever. Does that sound like a stable system to you? Does that sound like a system where you want to have all your wealth tied up in paper assets? Let me shift gears for just a moment, because if you're sitting on a significant amount of retirement savings, I'm talking $100,000 or more in IRAs or 401ks, there's something you need to know. Most people don't realize you can actually hold physical gold inside a retirement account. It's called a gold IRA, and it allows you to get the tax advantages of a retirement account while holding a tangible asset that can't be printed or devalued. I put together a free guide that explains exactly how this works, how to set it up, and what the rules are. You'll find it in the description below. It's worth looking into if you're concerned about protecting your retirement savings from what's coming. No pressure, just information that might be useful. All right, back to the bigger picture. Let's talk about supply and demand because this is where things get really compelling. Gold is a finite resource. There's only so much of it in the ground, and we're mining less of it every year. The easy gold has already been found. The low-hanging fruit has been picked. New gold discoveries are rare, and when they do happen, it takes years or even decades to bring a new mine into production. Meanwhile, demand is surging. Central banks are buying. Investors are buying. Jewelry demand in Asia remains strong. Industrial applications for gold in electronics and technology are growing. You've got declining supply meeting increasing demand. Economics 101 tells you what happens next. Price goes up. And we're not talking about a modest increase. We're talking about a potential moonshot. Some analysts are predicting gold could hit $5,000 an ounce within the next year. Others are saying $10,000 isn't out of the question over the next 5 years. And the really bold forecasters, the ones who understand the magnitude of the monetary crisis we're facing, are talking about $20,000 or even $30,000 an ounce if we see a real currency crisis or a collapse in confidence in the dollar. Are those numbers realistic? I don't know. Nobody knows. But what I do know is that the trend is clear. Gold has been in a bull market for years now, and every time it pulls back, it finds support at higher levels. Every dip gets bought. Every correction is shallow and short-lived. That's the hallmark of a strong, sustained uptrend driven by fundamental factors, not speculation. And here's the thing that should really get your attention. Most people still don't own any gold. The average American has zero exposure to gold. Their wealth is tied up in their house, their 401k, and maybe some cash in the bank. All dollar-denominated assets, all subject to the same risks, no diversification, no insurance, no plan B. When the masses finally wake up to what's happening, when the average person starts to understand that their dollars are losing purchasing power and their retirement accounts are at risk, where do you think they're going to turn? They're going to turn to gold. And when that happens, when you get real retail demand on top of the institutional and central bank demand we're already seeing, the price is going to explode. Think about what happened during the 2008 financial crisis. Gold went from around $800 an ounce to over $1,900 an ounce in just 3 years. That was a crisis that was largely contained to the United States and Europe. The system was stressed, but it didn't break. Central banks stepped in with bailouts and quantitative easing, and the crisis was managed. The crisis we're facing now is different. This isn't about subprime mortgages or over-leveraged banks. This is about the fundamental structure of the global monetary system. This is about trust in fiat currencies. This is about the end of dollar hegemony. You can't fix that with a bailout. You can't fix that by printing more money. In fact, printing more money is what caused the problem in the first place. Let me give you another historical parallel. In the 1970s, the United States faced a similar crisis of confidence. Inflation was raging, the dollar was weak, trust in government was at an all-time low after Vietnam and Watergate. People were scared. They didn't know what to do with their money, and they turned to gold. Gold went from $35 an ounce at the start of the decade to $850 an ounce by 1980. People who owned gold preserved their wealth. People who didn't got crushed by inflation. We're in a similar moment right now. Inflation has been running hot. The official numbers say it's coming down, but anyone who buys groceries or pays rent knows that prices are still way higher than they were a few years ago. And the government's response to inflation has been to raise interest rates, which is now creating a whole new set of problems. Higher rates mean higher borrowing costs for the government, which means bigger deficits, which means more debt, which means more pressure on the system. It's a vicious cycle, and there's no easy way out. The Federal Reserve is trapped. If they keep rates high, they risk breaking something in the financial system. If they cut rates, they risk reigniting inflation. Either way, gold wins. High rates make the dollar stronger in the short term, but they also increase the risk of a financial crisis, which drives people to gold. Low rates make the dollar weaker and inflation higher, which also drives people to gold. Gold is the trade that works in almost any scenario. Now, I want to talk about something that doesn't get enough attention, the difference between paper gold and physical gold. When most people think about investing in gold, they think about buying shares of a gold ETF or a gold mining stock. And look, there's nothing wrong with those investments if you're looking for exposure to gold prices, but they're not the same as owning physical gold. A gold ETF is a claim on gold. It's a promise that somewhere, in some vault, there's gold backing your shares. But you don't own that gold. You can't take delivery of it. You can't hold it in your hand. And in a real crisis, when the system is under stress, those promises might not be worth as much as you think. Physical gold is different. Physical gold is tangible. It's real. It's in your possession or in a vault that you control. Nobody can freeze it. Nobody can confiscate it without physically taking it from you. It's the ultimate form of financial sovereignty. And that's why central banks are buying physical gold, not paper gold. They're not buying ETFs. They're not buying futures contracts. They're buying bars and coins and storing them in their own vaults. They understand the difference between a claim on gold and actual gold. And if you're serious about protecting your wealth, you need to understand that difference too. Let me tell you about what's happening in the physical gold market right now. Premiums are rising. That means the price you pay for a physical gold coin or bar is higher than the spot price of gold on the exchanges. Why? Because there's a shortage of physical metal. Mints around the world are struggling to keep up with demand. Dealers are running low on inventory. When you try to buy physical gold, you're often told there's a waiting period. That's not normal. That's a sign of stress in the market. That's a sign that the paper price and the physical price are starting to diverge. And when that divergence becomes too large, when people lose faith in the paper market and demand physical delivery, that's when you get a real squeeze. That's when the price goes parabolic. We saw a taste of this during the COVID pandemic in 2020, when premiums on gold coins spiked to 10% or even 20% over spot. Imagine what happens if we get a real crisis. Here's another angle to consider: the geopolitical situation. The world is becoming more unstable. We've got wars in Ukraine and the Middle East. We've got tensions between the United States and China over Taiwan. We've got a global energy crisis. We've got food shortages in parts of the world. We've got political polarization and social unrest in many countries. All of these factors create uncertainty, and uncertainty drives demand for safe haven assets like gold. Think about it from the perspective of a wealthy individual or a family office managing billions of dollars. Where do you park your money when you don't trust the government, you don't trust the banks, and you don't trust the stock market? You buy gold, you buy real estate, you buy art, you buy assets that have intrinsic value and can't be inflated away. The ultra-wealthy have been doing this for years. They've been quietly accumulating gold and other hard assets, while the middle class has been told to put their money in index funds and trust the system. And now, as the system starts to crack, the wealth gap is going to widen even further. The people who own hard assets are going to preserve their wealth. The people who are all in on paper assets are going to see their purchasing power erode. I'm not trying to be alarmist here. I'm not saying the world is going to end tomorrow, but I am saying that we're in a period of significant transition. The old order is breaking down. The post-World War II system of dollar dominance and American hegemony is coming to an end. And in times of transition, in times of uncertainty, gold has always been the asset that preserves wealth. Look at what happened in Venezuela. Look at what happened in Zimbabwe. Look at what happened in Weimar Germany. When currencies collapse, when hyperinflation takes hold, the people who own gold survive. The people who don't own gold lose everything. Now, I'm not saying the United States is going to turn into Venezuela, but I am saying that the risks are higher than most people realize, and the consequences of being wrong are severe. Here's the bottom line. Gold at $4,000 an ounce isn't expensive. It's not overvalued. It's not in a bubble. Gold at $4,000 an ounce is a reflection of the loss of confidence in fiat currencies and the growing recognition that the global monetary system is broken. And as that recognition spreads, as more people wake up to what's happening, the price of gold is going to continue to rise. The question isn't whether you should own gold. The question is how much gold you should own and in what form. Some experts recommend having 5% to 10% of your portfolio in gold as insurance. Others recommend 20% or even more, depending on your risk tolerance and your view of the world. But almost everyone agrees that having zero exposure to gold in the current environment is a mistake. So what should you do? First, educate yourself. Understand what's happening in the world. Understand the risks to the financial system. Understand why gold is rising and why it's likely to continue rising. Second, decide how much gold makes sense for your situation. If you're young and have a long time horizon, maybe a smaller allocation makes sense. If you're closer to retirement and more concerned about preserving wealth than growing it, maybe a larger allocation makes sense. Third, decide whether you want physical gold, paper gold, or a combination of both. And fourth, take action. Don't wait. Don't procrastinate. Don't assume you have all the time in the world. The window of opportunity to buy gold at reasonable prices is closing. Every day that goes by, more people are waking up to what's happening. Every day that goes by, central banks are buying more gold. Every day that goes by, the supply of physical gold gets tighter. And every day that goes by, the risks to the financial system grow larger. This is your warning. This is your wake-up call. The smart money is already positioned. The central banks are already positioned. The ultra-wealthy are already positioned. The question is, are you going to join them, or are you going to be left behind? Gold isn't just a metal. Gold is money. Gold is insurance. Gold is freedom. Gold is the asset that has survived every crisis, every war, every currency collapse in human history. And gold is going to survive whatever comes next. The final warning has been issued. The signs are all around us. The data is clear. The trend is undeniable. Gold is telling us something. The question is, are you listening?